Hi YouTube, so it's eventually time for me to give you all my scalping futures strategy. Alright, it incorporates the footprint chart and market structure. Alright, my opinion, this is the best strategy there is out there for daily scalping to grow futures accounts. Okay, this is mostly just what I do for my futures account. Alright, when I trade for CFD prop firms, I'm using higher time frame, entering on, for example, 1 hour, 30 minute, 15 minute, sometimes 5 minute. This example, this strategy here, we are mostly focusing on the lower time frame, so the 5 minute is 3 minute, 5 minute is what you want to be looking at for your entries. Okay, so let's jump into the basics of our POI. Alright, so if most of you that are trading ICT will know external range to internal range liquidity. Alright, internal range liquidity for ICT is known as fair value gaps. For us, we're going to call it swing points. So if we have got an example for you, let me find one. So if we have got a range high to range low, this is going to be our internal. Alright, it's going to be an internal swing point within the premium or discount of the range. In this example, you want it in premium because it's a bearish leg. Okay, so if we draw our fib, we want to be looking for our swing internal range within the upper half of that. Alright, there's more to it, but I'm just going to keep it as simple as possible for you. Basically, this is the last area where institutions were buying before the area dropped. It's a market maker model, but I'm not going to jump into that. Just understand it as find a range, mark the range out, and then find the internal range within the higher 50%. Alright, and what you want to see is you want to see price come up, trade to this level. Once we sweep through the level, we are then going to be looking on the footprint for our entry criteria. Alright, you want to be using mostly 1 hour and lower ranges. Okay, if we have a look at the 30 minute, you can see the 30 minute internal ranges much clearer. Okay, so let me find a couple of examples. Again, I'm just literally putting this video together through my head. There's no nothing planned or anything like that. So again, this would be one here. So range low to range high, mark out our 50%. Where is the last swing point within this area in the discount? It's going to be this low here. Alright, nothing here. Yes, it's in the discount, but you want to find the last swing point within the range. Okay, and this is the range here. So again, we would mark it out. Again, this one fails, but we would then be waiting for a footprint entry in here, and obviously we aren't going to get the entry within here. Okay, because the market is bearish. Again, we have this SMT, the price starts going lower. If we then look at the new ranges, we would have this range high to range low. Swing point within it, which would be here, sweep it, entry in here, and then we take it lower. Alright, so that is just the main key focus that I want you to understand, is that we're looking for a range, and then you take the high swing point within that range. Alright, there's another example here. The high to the low of the move, find the high swing point within that and the premium, which is right here. We would then mark it out. That's our POI. We're then waiting for this to get swept. Then we look for confirmation on the footprint to enter the trade. So our entry would probably be around about here. Stop above the high, and it would be either a 1R or a 2R, whatever you want to take. Preferably 2% 2R trades, but when you first initially start an account, you want to grow it slowly, you want to build a buffer, so I would take 1% please. Okay, so anyway, you've got the idea of what we're looking for on here. It works on every pair. What I mostly do for this strategy is I'll use EU, so 60 if you're using futures, and crude light. Okay, crude is the exact same. A trade that I took yesterday, could have held it, Sorry, it wasn't this one. That was another play, but it was in here, and it's still going. But yeah, I don't really want to talk about it because it annoyed me. But basically, at 9 p.m. last night, I closed the trade, and it just melted basically. So again, I call it IOP, institutional order pairing. So this is going to be our range here. I'm on the 5 minute here though in this example, and this is a range high to range low. You could use the higher one if you wanted, but for me, this is where the more aggressive move was at. I also took an entry in here for a 1-to-1 play. But again, mark out our range high, range low, find our swing point within the premium, which is here. Why would I not use this one? Because say if I use this zone and I use this swing point, price would need to come up too far to then drop. Alright, the market opened, and then I just thought we'll come up, we'll sweep that, and then we'll drop lower. Okay, that was this morning. Yesterday. And as soon as we got that, we got the entry within the footprint. So I'll go over that example for you and show you what I'm looking for confirmation in the footprint. But your stop loss will always go above the swing point. And then this morning again, there was another one. If we use a range high to range low, high swing point, which is here. Obvious one, you wouldn't use that because it's not very obvious. You could use it and it does play it even better, but I'll use the obvious swing point. We come up, we sweep it, and then we just initially drop. Alright, now what I'm looking for a sweep of here, and then I'll look for a confirmation, push a leg. I'll then look for a nice leg higher. That will look something like this. Wait for it to get swept, the minor range within it, and then we push higher. Okay, so I'll look to enter in here. But yeah, let's go back to this trade, and I'll show you this one from this morning that I never took because it was out of my trading time. I didn't get to the charts till about here, and I'll show you this one. So let me bring this screen over on the footprint chart, and exactly what we're going to be looking for is, where was that entry this morning? That was it here. Okay, wasn't a textbook one. I probably wouldn't even have took this if I was at the charts. New day opens, we come down, we push higher. Alright, what we want to see is we want to see aggressive selling at the lows. Okay, so you want to see above 25 on the delta. So on the right hand side it's delta, on the left it's your bid and your ask. Okay, so on the right hand side, once you take the high, we're going to wait for the candle to push up, take the high, and then close lower. Okay, once we get the lower close, we want to see aggressive selling at the lows. You also want to see aggressive buying at the highs to show that traders are either breaking out or there's limit sell orders at the high. Alright, you want to make sure the top tick is under 100. Alright, so the buyers are under 100, which is here. We've got aggressive buying at the top. We want to close under the POC. It's even better if the POC is in the top 3 ticks, showing that there's even more trapped sellers. Alright, we then close bearish, and then you want to look at the delta down here. If you have a negative delta, you want the negative delta to be 10% or more. If you have a bullish delta, like it is here, we've got a bullish delta but the candle closes bearish, that is fine. That's just a delta divergence, pretty high probability to then enter on the close of the candle, open with the new candle, and take the price lower. As you can see, we pretty much melt as soon as that happens. So that is what we're going to look for on the footprint at the highs. Alright, you want to see the trap. It's either, you don't know if it's a trap, it's either a trap, as in there's buyers, breakout buyers getting trapped above the high, or it's limit sell orders. Then once you see that happening at the high of the candle, we want to wait for a bearish close, and you want to see the aggressive sellers coming into the market at the low of the candle. You want to see it close below the POC, and then you look at the delta. Alright, again you want the high to be under 100 as well. Yesterday, let's go to that trade. This was it here. So what happened here, this is exactly where we come up here, take out this high. Alright, so that is when we sweep this high, and then I was looking for the short. Alright, so as price is coming up, we're seeing the buyers getting trapped. Either they are either breakout buyers or aggressive limit sell orders. We see them getting trapped. Alright, we have then got under 100 on the buying side. Alright, which is the ask. We then close the candle bearish, close below the POC. We have a negative imbalance, which is good. And then on the delta, again, we're nearly at 10%, so I was confident in the trade. Alright, nearly at 10%, so that is good enough to take the entry either on the close, open of the new candle, or you take it 2 ticks below the POC, which was the open anyway. So entry was here, stop above the high, and as you can see, price melts to the downside. Okay, now what will I be looking for the rest of the day? I'm bullish overall, so I want to see price pushing higher. As you can see, we come into this fair value gap. We're going to take out the previous day's low. Hopefully we respect this, and then we can start to see a push higher. So once we take out the previous day low, which is here, which has just happened, I'm going to be looking for the confirmation on here. Okay, nothing yet. We're pushing down, yeah, bearish candles, nothing yet for me to then take along. But that's exactly what you want to see on the highs and lows. Once we take the highs and lows, again, this is a low that I would not take, because as you can see, the delta is pushing out the way. So as in, there's more sellers wanting to get involved as price is pushing down. You want this to taper off. You want it to be like a little V shape down into the candle at the low. Alright, this is going out the way, showing that there's sellers willing to sell price lower down here. So then what happens most of the time, price will come back and we'll take it out. Alright, and you basically, it's called a dirty low and a clean high. Alright, a clean high is when we taper off at the low and there's no willingness of sellers to continue taking price lower. So I wouldn't take this trade, even though everything else matches up. You can also see we've got a bearish imbalance at the low here, but we close the candle bullish, we're aggressive buyers at the high, so it does start pushing up a bit, but the target would always be price to come back here because it's a dirty low. The market does not like to leave dirty lows within the marketplace. Alright, you want it to be under 100 at the highs. This to me is clean. Price doesn't need to come back up here. It does though, but that's just because the market order flow is bullish. Alright, so at highs you want to see something like this. Buyers tapering off. As you can see, the V is pushing into the candle. 28 contracts wanting to take it long, so there's not many buyers willing to take higher prices. Candle closes bearish below the POC. The only thing missing on this is we don't have sellers coming into the market. So what you would do is you would wait for to see sellers and completed highs. Alright, this low again, no buyers wanting to push price higher. We then start selling off. Again, what happens? We try and push up one more time. What happens? The buyers are not willing to push price higher, accept higher prices. So then what happens is we then push up. We've got two negative bearish imbalances at the high of the candle. We're tapering off on the delta. We close below the POC. We close at the low, and we've got aggressive sellers coming in. You can sell here, stop either above this high or above this high. Personally, I'll put it above here. 15% negative on the delta, showing strong sellers, aggressive sellers wanting to push price lower. Alright. Again, if anyone wants this footprint that I use, it is from TDU. What they called? TDU indicators or something it's called. It's on NinjaTrader. But again, we're only looking for this pattern once we take out an internal high, okay? And then we want to take it down to either an internal low or an external low. Alright, we're not using fair value gaps, we're not using anything like that. It's just basically internal ranges and then looking for the opposite move. Alright. Again, look at this. This to me is not very clean. We've got blocky orders at the lows. Price will want to at some point come back and take this out. Again here, blocky order, 131 sellers here wanting to take price lower. So market, there's willing sellers to sell down here, so the market will usually come back to this area. Alright, if you're buying though and you see this at the high of the candle, that is a good sign, because you know that there's still willing buyers wanting to take price higher. Then when we start tapering off, you know this could be a sign of a reversal, and we could start turning and going the opposite way. Alright, so you don't just take this pattern blindly, you only take the pattern once we then take out an internal range. Okay, so again here, look at this, price is pushing down. Let's imagine that this is an internal range. We sweep the low, we then look for our entry pattern, which is tapering off on the delta. Sellers also getting trapped down here. Alright, we close above the POC. The candle closes bullish with an aggressive buyer up here. You can either enter on the close of the candle, or like I said, 2 ticks above the POC, 1, 2. That is a textbook absolute nailer of a trade. Okay, picture perfect, no drawdown, and you'll start just pushing higher. Alright, so that is exactly what you want to look for. Right hand side is the delta, tapering off on the delta, no willingness for more sellers to sell down here. We then close bullish over the POC with aggressive buyers at the high of the candle. Then we can look at the delta. We've got a delta divergence, which is good. It's fine for us to then take the trade. For a continuation trade, you just look for the exact same thing, wait for the push up, wait for us to retrace. Then what do you want to see? You want to see exactly the same as everything else. You have a look, price pushes down, imagine this comes into a POI, no willingness for sellers to sell lower. Again, the sellers 87, not under 100. We then push higher, aggressive buyers coming in, close over the POC. We can then either take it 2 ticks above, 1, 2, or at the close. Again, you'd probably be stopped out of this one, but that is the exact theory. As we start pushing higher, when you see orders at the highs, you know that price is wanting to keep continuing higher. So yeah, I think that will call it for this one. If anyone's got any questions, please give me a shout and I will get back to you as soon as possible. Again, we've taken out this low and we're starting to react. If we jump on to the footprint, let's see if we've got anything yet, to see if I can explain anything for you. Again, still nothing. Sellers coming down, sellers getting trapped, yes. That is showing an unwillingness for more sellers. But if we look at these 2 lines here, let's see if there's large sellers wanting to sell lower than it. So pretty big sellers down here, 191 and 62. So again, I think we'll come down to this green line before we start moving higher. But as you can see, we pushed down, aggressive sellers. We didn't get it in this candle, but the next candle comes down. There's no willingness of sellers anymore. We then start we've tapered off on the delta. We're now starting to push higher. Aggressive buyers, as you can see on the right hand side, are coming in and potentially closing over the POC. So it could potentially be an order, but with 6.7 on the buyers delta percentage, I would not be looking to buy this until it was at least 10. 9 if there's other confluences, but mostly you want about 10. Then where would you be targeting? You'd be targeting the buy side, so there's buyers up here, dirty highs up here, a lot of buyers were willing to buy up here, so price will most likely go up to there today. And yeah, we'll see how it goes. Just let me confirm one more time what you want to see within the time frame, the bar charts. As you want to catch a range, mostly I'll look at the 15 minutes for it. Alright, you look at a range playing out such as this. Imagine we were bearish. I'm obviously looking for buys, but if we were bearish, this would be my target. Because I'm bullish, this is what the target that I've marked there is, the range high to range low, last swing point in the premium. Mark it out, and that is where I am looking to target. If I'm getting an external range, which I am, this would be external. My target would be at the internal. Even though I think price is going to go up to here, I'm not being greedy. I'm building a buffer, and I'm just getting little small plays in. Okay, so you wait for price to then come up to here, take your profit, and then you look for your next opportunity. Again, I want to see this push higher, but it's not the best for me here. This would be a long, but again, not very aggressive on the buyers. Buyers still failing to show up. So yeah, that is it. Any questions, give me a shout.